Welcome to Stock Spotlight. I'm Michael, your guide to the stock market. In each episode, we analyze companies that have earned a watch or pass rating on my 33-question research checklist. Today, we're shining the spotlight on Evolution AB, ticker symbol EVO, and ticker symbol EVVTY, and we'll be uncovering what makes it an intriguing investment opportunity. Join me as we explore the insights and strategies that empower savvy investors like you to make informed decisions. Let's dive in. We'll first start by reviewing my 33-question checklist that evaluates companies across 9 categories, including fundamentals, management quality, industry position, momentum, historical and future growth, capital allocation, capital structure, and valuation. By doing so, we aim to gain a holistic understanding of a company's strengths, weaknesses, and potential as an investment opportunity. To date, we have screened 208 stocks across 9 sectors and 67 industries, with a mean quality score of 59%, a standard deviation of 15%, and a top quartile benchmark of 70%. 26% of the companies have passed, 59% have earned a watch, and 15% have failed. In terms of company size distribution, 82% of companies analyzed are what I would call large caps, 17% are mid caps, and 1% are small caps. We have also analyzed a broad sector distribution, with no sector more than 20%. Consumer discretionary is the highest at 19%, and communication services is the lowest at 4% analyzed. For Evolution's overall stock evaluation, they were rated in November 2024, and data used for this episode is as of Q4 24, with some Q3 data for valuation. They earned a 77% quality score, which is in the 89th percentile overall, and 92nd percentile in their sector, right behind Ferrari and right ahead of Zoetis, 2 quality companies in their own right. Their 77% quality score earned a pass rating. Schwab gave them a C, and Guru Focus gave them a 93, which is the 75th overall and 71st in their sector. I do want to note that Guru Focus has much higher scores overall than my method, so you'll see absolute scores like 93 in the 70th something percentile. I'll now discuss Evolution's business and industry. Evolution is in the hotel gaming industry within the consumer discretionary sector, and as of Q4 24 earnings on January 30th, 2025, their market cap is $16.5 billion, when shares are down 7% after the Q4 report. They are a large cap by definition, but mid cap in reality. Evolution AB was founded in 2006 by Johns von Baer and Frederick Osterberg. It has grown from a startup focused on live casino solutions to a global leader in online gaming technology. Key milestones include: in 2013, they launched their 100th live table, becoming Europe's largest single-site casino operation. In 2015, they listed on the Nasdaq First North Premier Stockholm exchange. And in 2018 to 2020, they expanded globally, opening studios in Canada, Georgia, the US, and Lithuania, and launched games such as Monopoly, Deal or No Deal, and Crazy Time. During the 2020 to 2022 years, they acquired around 3 to 4 different companies and diversified their product offerings. In 2023, they introduced Funky Time, a 70s disco-themed live game show follow-up to Crazy Time that has become a big hit as well. And in 2024, it was a more turbulent year with the Georgia strike, the UK compliance investigation, and their CFO departing. So Evolution is a service business. They develop and license B2B online gambling solutions, primarily to gaming operators. Their value proposition is that they solve the problem of bringing in a real casino experience to online platforms, which I do think is hard to do given the online gambling world is fraught with challenges like trust issues, high stakes with real money on the line, and technical hurdles. Their product portfolio, or what they call game type, includes live casino games and game shows. This is around 85% of revenue, and it includes traditional table games like blackjack, roulette, and baccarat with live dealers, as well as innovative offerings like Monopoly Live, Deal or No Deal Live, and Crazy Time. Their annual report mentions that their game show category is now the biggest by player count. There's also the random number generator, or RNG, game segment. This is usually around 15% of revenue,
and it includes slots and first-person games. They are primarily focused on the live game type, which has less commoditized offerings and stronger growth. Two of the strongest brands in their portfolio are Lightning Roulette and Crazy Time. I then like to look at whether a company's products or services are discretionary or essential. In Evolution's case, they're primarily discretionary. Online gaming and casino experiences are entertainment products that consumers choose to spend money on rather than essential goods or services. Evolution operates globally, with significant revenue coming from Europe and Asia, around 75% of total, in fact, and growing markets in North America and Latin America. For Evolution, you also need to look at regulated versus unregulated markets. The share of revenue of their regulated markets tends to hover around 40%, and the remaining 60% comes from unregulated markets, which can either be gray, which is not explicitly regulated or illegal, or black, which is explicitly illegal markets. This 60% presents both opportunities and risk, since there's potential for growth as markets become regulated, but regulatory changes could impact operations and revenue. Europe generated 779 million euros in fiscal 24, which was 38% of net revenues and 10% growth year over year. Europe is a mixture of regulated and gray markets. It's always been their top market, but that is changing with new regulation and expanded global scale. Asia generated 803 million in revenue in fiscal 24, which actually topped Europe. It was 39% of net revenues and grew 19% year over year. Asia is largely considered a mixture of gray and black markets, and they've had growth for every quarter for the last 5+ years, except for I think in Q4 24, which was flat quarter over quarter. North America was 258 million euros in fiscal 24, which was 13% of net revenues and had 14% year over year growth. North America is primarily regulated with expanding legal markets, also where perhaps the largest geographical growth opportunity lies for Evolution. Latin America was 146 million euros in fiscal 24, which was 7% of net revenues and 16% year over year growth. This is an emerging market that became part of the business back in Q2 22 and is a mixture of regulatory statutes. It was only broken out as a separate region in 2023. There's also an others category, which is 3 to 4% of net revenues. In terms of seasonality, the annual report says that operations are influenced by seasonal patterns in end user activity, specifically increased activity and volume in Q4 of each year. Evolution's customer base is concentrated within the online gambling industry. Their primary customers are gaming operators who offer their products to end users. The end users are individual gamblers who then play their products. Evolution has a customer dependency percentage of revenue metric that they track in their annual report, and their concentration among their top 5 customers has increased from 27% in 2019 to 46% in 2024. I don't believe they break this out further by aggregators. Finding a good industry is as important as finding a good business. The online gambling industry in which Evolution operates is relatively attractive due to its expanding market size, low supplier power, and only medium threats of new entrants or substitutes. But its sin status might knock it down a point or two with investors. I did a Porter's 5 Forces for the industry, and for industry rivalry, I said around moderate. There's not many direct competitors, and the industry competes less on price and more on product quality and player engagement. Buyer power, I rated moderate. While there are many gaming operators, the end users have power depending on how you rate switching cost, and they also have relatively easy access to competitor reviews. Evolution's strong brand and innovative products does help mitigate this to some extent. Supplier power, I felt, was low. Evolution develops most of its technology in-house, reducing dependency on external suppliers. I rated their threat of new entrants as moderate. While barriers to entry in the online casino industry are low in terms of initial capital investment, execution barriers are rather high. I also said their threat of substitutes was moderate. Traditional land-based casinos and other forms of entertainment do pose a substitution threat. However, the convenience and increasing acceptance of online gambling mitigates this threat to some extent. In terms of the total global gaming market, Evolution's 2023 annual report uses estimates from H2GC to size the total global gaming market, which is land-based plus online, at around 490 billion euros. Roughly 25% of that is online, split between 17% RNG, 5% live casino, and 3% slots. And for the past 5 years, Online gambling has outpaced land-based casinos in revenue growth, achieving a CAGR of 20% versus 0.3% for land-based casinos. It's interesting that RNG is the largest vertical, but live is the growth engine. Using that 25%, global online gambling is valued at around $123 billion in 2023. According to Grandview Research, online gambling is expected to grow to CAGR of around 11.7% from 2024 to 2030, where it will be at $210 billion. Evolution's revenue was around $2 billion in the trailing 12-month Q3 24 for a revenue share of only around 2%. They did grow faster than the industry in 2023, while we'll wait to see the annual report for 2024's update. I think Evolution's industry sizing might be a little high, as Grandview Research suggests an online gambling market closer to $94 billion at the end of 2024. It's also worth noting that Grandview's definition includes sports betting, which is not an area that Evolution has entered yet. InvestorsGrow.com forecasts Evolution's revenue to grow at around 12.5% through 2027, which does indicate potential for market share expansion. From a player activity standpoint, the story is different. There's a great follow on X at MARIENLECHEV, Marian Lechev, who updates game show market share every month based on player activity, and Evolution is currently between 69 to 72%. In terms of the competitive environment, few direct competitors exist due to Evolution's unique focus on live casino and game shows, where most competitors also operate in other areas like sports betting. Playtech is the largest competitor by revenue. Their ticker symbol is PTEC, and they had $1.7 billion in trailing 12-month revenue as of the first half of 24, which is slightly smaller than Evolution. Playtech has typically lacked the fundamentals that Evolution has, although they do have a stronger presence in regulated markets. The other notable competitor is Pragmatic Play, which is a private company that has an estimated revenue of around 100 million euros or so. They have a strong presence in Canada and in slot games, and are also rapidly growing blackjack and live casino. Their most famous game is the slot game Sweet Bonanza. Uncomparably, only Evolution is rated. They have an 83% customer loyalty rating and an NPS of plus 57, which is very solid. Overall, Evolution is a dominant player in a growing industry. There is some customer concentration risk, depending on the aggregator breakout and market share loss potential due to competitive alternatives. But their dominant position in live casino and game shows is evident by a broad selection of innovative games, mixed in with name brand licenses for Monopoly and Deal or No Deal. Next, I'll analyze Evolution's business model through both the strategic and data-driven lens. In terms of revenue generation, Evolution generates revenue primarily through recurring commission fees, which is calculated as a percentage of the operator's winnings generated via Evolution's product offerings. While the company does not officially disclose its commission rates, sources suggest they typically range from 10 to 20%. This model creates a stable, recurring revenue stream tied to the success of their B2B clients. They have two sales channels: direct sales to operators and then indirect sales through aggregators. Once an online casino operator gets big enough, Evolution provides its services directly to them. They get commission and additional revenue from setup fees and dedicated table fees, which are monthly charges for exclusive tables. Aggregators instead integrate multiple APIs from companies like Evolution and its competitors. While this channel helps expand reach, there is some risk around Evolution involuntarily being in black markets due to the actions of aggregators. Outside of setup fees, revenue is recognized at a point in time, primarily when the gaming activity occurs. Setup fees, while initially recognized after go live, are reviewed annually for materiality and potential changes in accounting approach. The company's revenue is influenced by several factors. These include the number of active operators and their success, player engagement and retention rates, and strategic geographic expansion. Innovation plays a critical role too, especially in the live game type. In terms of marketing, Evolution primarily targets B2B relationships with gaming operators, as they don't directly market to end users. There's not a whole lot else to talk about with marketing for Evolution. I do believe that they exhibit at least medium to strong pricing power due to their leading market position, which is reflected in the high margins that we'll see shortly. Their superior product quality and unique offerings justify higher commission versus many of its competitors, making operators willing to pay for the value provided. The price elasticity of their services is relatively inelastic. Their products are not just add-ons, they're integral to the core operations of gaming operators. This, I believe, makes their customers less likely to delay purchases or switch to different providers just because of price changes. Evolution's games have a significant impact on the gross gaming revenue, or GGR, for many of its operators, further reducing price sensitivity. And here's another crucial point to consider. Their gaming services likely fall under the cost of goods line item in operators' income statements. This categorization typically indicates essential spending. For product development, Evolution doesn't formally break out R&D on the financial statements, but they most likely go into the other operating expenses bucket, which is about 25 to 30% of revenue. What we do know is that they are constantly developing new games. I know there were over 100 in 2023 alone, and we'll see how many in 2024 once the annual report is released. In terms of its quality growth attributes, Evolution got the green checkmark for 6.5 out of the 7 characteristics that I measure. Their high ROIC with strong free cash flow per share growth is a powerful combination, but management concerns and business risk dock them 0.5 point. In terms of moat, there's no Morningstar rating, but I give Evolution a wide economic moat due to them having multiple different strong moats. For one, Evolution holds significant IP in both its OSS, or one-stop shop platform, and in exclusive games. Their OSS acts as an integral enabler of their games for casino operators and a foundation for future product expansion. Exclusive games make it difficult for competitors to replicate their offerings. There's also a twofold low-cost scale advantage. First, due to their large user base, think Netflix, they have cost efficiency in developing new games on a per-player basis versus many of their competitors. Also, its games can support hundreds or even thousands of players betting simultaneously, which spreads fixed costs across more users. Ultimately, this leads to superior unit economics versus traditional land-based casinos. You could also argue that there's a network effect in play. As Evolution attracts more players, it becomes more attractive to casino operators. Finally, they most likely have a regulatory moat, as they developed a strong capability to navigate global regulations and secure the necessary licenses. Now looking at returns and predictability, I first like to ask, is their annualized price return CAGR greater than the S&P 500 since Portfolio Visualizer tracking began? For Evolution, it's a yes. It's 37.1% annualized CAGR versus 14.8% for the S&P 500 from October 16 to December 2024. I next like to ask, have there been any EBIT operating losses over the last 10 years? For Evolution, there has been none, which is good to see. Then I like to ask, is the Guru Focus predictability rating at least a 4 out of 5? Yes, Evolution has a predictability rating of 5 out of 5, which suggests that their revenue and EBITDA per share have been very consistent over the last 10 years. For what it's worth, in backtest, companies with 5-star ratings have had the highest total returns. I then like to ask, is the 10-year free cash flow linearity at least 0.75? Yes, free cash flow linearity fit is 0.92, and free cash flow per share is 0.90, well above my target of 0.75. The exponential fit for both is even higher. For profitability, the first question that I'd like to ask is 10-year average gross margin at least 40%? Yes, as Evolution essentially has 100% gross margins, their income statement actually lists no cost of revenue. And then the second question I'd like to ask is 10-year average SBC adjusted free cash flow margin at least 15%? For Evolution, yes again. The 10-year free cash flow margin is 39.7%, which is significantly higher than my 15% benchmark. These are impressive free cash flow margins typically only seen in large tech companies. In terms of growth, there's 3 questions I'd like to ask. First, is 10-year revenue CAGR at least 5%? Yes, Evolution's is 49.4%, which is also significantly higher than the mid-single digit benchmark. Despite the slowdown in revenue growth the last few quarters, Evolution has experienced exponential revenue growth historically. Then I'd like to ask, is 10-year free cash flow per share CAGR at least 10%? Yes, for Evolution, it's 61.4%, higher than the revenue CAGR, and also way higher than my 10% benchmark. The third question is 10-year average free cash flow conversion at least 100%. So that equation is free cash flow per share divided by diluted EPS. This is the only no so far, as Evolution averages 95% free cash flow conversion over the last 10 years. This is actually still quite good, so despite not hitting my target, I'm still impressed. Then there's value creation. I like to first ask, is 10-year average ROIC at least 20%? And then ideally higher than its 2024 industry average? Yes, The combined stock analysis and quick FS average ROIC for Evolution from 2014 to 2023 is 37.8%, which is significantly higher than my 20% benchmark and the 12% 2024 NYU database average. The combined standard deviation is a little high at 16.6%, partly due to some acquisitions. I'd then like to know, is ROIC trending up if it's lower or holding steady if it's high? ROIC has been trending up after the 2020 acquisition of Net Entertainment that led to a 20% plus drop from 2019. I'd then like to know, is ROIC consistently greater than the WACC and trending up if lower or holding steady if high? Yes, from 2019 to 2023, using Guru Focus WACC data and combined ROIC from above, the ROIC minus WACC average spread is approximately 15%. We'll now dive into a high-level overview of Evolution's 3 financial statements. First, the income statement. Revenue has experienced exponential growth for the last 10 years. Trailing 12-month growth, though, is around 12%, so there has been a slowdown, but analysts still forecast double-digit revenue growth for at least the next 3 years. In terms of margins, I mentioned they have 100% gross margins, with operating margins hovering in the low 60s since 2021, and net margins are over 50%. The key operating expenses for Evolution are labor for deals, technology, infrastructure, and security measures. The personnel expenses line item, which includes labor, is about 20% of gross profit. Their annual report notes that IT and product development costs are also included. Their second operating expense is depreciation, amortization, and impairment, which encompasses studio expansion efforts, acquisitions, and write-offs. This is usually around 7% of gross profit. Then there's an all-encompassing other operating expenses line item, which is around 15 to 17% gross profit, and that includes acquisition costs, short-term leases, and any credit loss reserves. My one qualm here is that they don't break out R&D within the other line item. Evolution has historically had very low net financing costs, which is the difference between interest expense and interest income. They averaged 0.1% of net income for the last 10 years. In fact, the last few years, Evolution has actually generated more interest income than interest expense. Evolution's interest coverage ratio over the last 10 years has averaged 342, which is significantly higher than the Guru Focus travel leisure industry median of 4.6 and my personal benchmark of 10.0. Its peak was reached in 2019 at 716, but it's been comfortably above 100 for the last 4 years. This ratio is important because it measures how easily a company can pay interest on its outstanding debt with operating income. Evolution has very little default risk. In terms of the balance sheet, there's 2 assets to pay attention to. First is goodwill, which makes up around $2.3 billion, and that's 47% of total assets. So this suggests significant acquisition activity above my 30% threshold and above the 2024 industry average of 15%. Goodwill as a percentage of total assets was actually below 5% from 2014 to 2019, but skyrocketed up to 50% plus after several acquisitions. So it's worth keeping an eye on for sure. There's then cash and cash equivalents, which is around $986 million or 20% of total assets. To me, this just suggests that Evolution has a strong cash position. In terms of top liabilities, there's current tax liabilities, which are $420 million or around 40% of total liabilities. And this is just income taxes payable in the near term. And these liabilities may include corporate income taxes, gaming taxes, and other regulatory fees in various jurisdictions. There's then an other long-term liabilities, which is around $280 million or 30% of total liabilities. They don't detail this in the annual report, but it could be leases, deferred tax liabilities, etc. In terms of their capital structure, I first like to look at debt to equity ratio, which measures solvency or leverage. The latest quarter debt to equity ratio of 0.02 is well below my threshold of 1.50 and the 0.44 industry median. It's been below 0.15 for the last 10 years, which suggests that Evolution has a conservative capital structure with minimal reliance on debt financing. I then like to look at the cash to debt ratio. This measures liquidity. The latest quarter cash to debt ratio is a whopping 8.09, and the ratio has averaged 7.43 over the last 10 years. This is well above my benchmark of around 0.75 to 1.0 and the 0.54 industry median. Evolution is sitting on a nice net cash position. Then there's the cash flow statement. This is my favorite statement, and it's broken down into 3 areas: operations, financing, and investing activities. I'll discuss a few key metrics that I like. First, stock-based compensation or SBC intensity. Evolution actually does not have stock-based compensation, so don't have to worry about this. There's then capital intensity. Evolution has historically had above average capital expenditure requirements. They actually have a 10-year average of 6% of revenue versus the total market, which is around 4%, and its industry average, which is 2%. Although as of fiscal 23, CapEx as a percentage of revenue was only at 2.3%, so we'll see how 2024 adds a new data point to the trend. There's then investment intensity. Evolution's investment intensity ratio has averaged 172% over the last 10 years, suggesting a strong commitment to investing in fixed assets to grow the business. However, their investment intensity ratio has hovered below 100% for 2 of the last 3 years, most likely due to the acquisitions made and the subsequent increase in D&A expenses. The industry average is around 112%. Let's now discuss Evolution's leadership structure, compensation practices, and capital allocation strategies. Evolution is not currently founder-led, but their co-founder does remain involved as the chairman of the company, and he owns more than 10% of the shares. Their CEO is Martin Carlson, and he has been CEO since October 2016, a total tenure of over 8 years, which is above the US average of 4.8 years that I like to benchmark against. His total compensation for 2023 was around 5 million euros, with a 0.3% ownership stake in the company. Simply, Wall Street notes that his compensation is above average for companies of similar size in Sweden. And it's also worth calling out Todd Haushalter, who is the Chief Product Officer and has been with Evolution since 2015. He gets a lot of credit for making Evolution's games best in class. And if you want to learn more about him, listen to his conversation on the Next.io podcast. I then like to classify all companies by my classification system, and Evolution would go under long tenured manager. Martin Carlson has extensive experience in the gaming industry, having served senior level executive positions at other companies before taking on the CEO role for Evolution. Looking at Glassdoor, Evolution has average scores across the board. They get a 60% recommend to a friend, 51% approval of CEO, and 44% have a positive business outlook. In terms of compensation philosophy, they state that they want to offer market-based remuneration to attract and retain qualified employees. Their compensation structure primarily consists of a base salary and long-term incentives provided through warrant-based programs. There is no variable pay component, which I often see in American companies. In 2023, there was also what they call an extraordinary remuneration to leadership in connection to acquiring warrants in Evolution. This cash-based retention schema made up 45% of the CEO's total comp, with base salary around 55%. This does raise some questions around needing this program long-term to retain key talent. I feel like a variable or performance component is kind of missing here. One thing I do like is the table at the end of their remuneration report with CEO pay as a percentage of company operating profit. This averages 0.6% the last 5 years and has been fairly steady. For capital allocation, I give them a satisfactory rating but needs improvement. While Evolution does have a structured approach to capital allocation and could one day become a share cannibal, there are some concerns about the dividend policy, dilution, and the effectiveness of the recent RNG acquisitions that temper the overall rating. Evolution is committed to paying a dividend of 50% of net income annually, and they also announced a 500 million euro share buyback program in Q4 24. Ideally, I wouldn't want a growth company like this paying any dividends, but I understand that Swedish culture might be a bit different than American culture. The issuance of warrants as part of the compensation plan also poses a risk of dilution, with the 2023 report indicating a potential dilution effect of 0.9% from the 2023-2026 program and 1.6% from the 2021-2024 program. I then like to look at acquisition intensity. This is acquisitions as a percentage of operating cash flow. Since there were no acquisitions prior to 2018, the 2019 to 2023 average is 14%, which would put Evolution square in the middle of my medium intensity bucket. Their track record of acquisitions hasn't been awful, but it also hasn't been great. I would be hesitant seeing large acquisitions in the future. I then like to look at shareholder distribution, which is dividends plus buybacks divided by free cash flow. Evolution's 10-year average is a very respectable 36%. I like to see companies below 100% over the long term. In terms of shares outstanding, their diluted shares outstanding have increased by 24% the last 10 years and 19% the last 5 years, but have actually declined by 2.3% over the last 3 years. This is a nice trend to see that should continue after the recent buyback program was announced. I'd now like to briefly discuss Evolution's ownership structure. Ideally, I want high insider and institutional ownership. Looking at the 2023 annual report, insider ownership is somewhere between 10 and 15%, and institutional ownership is around 55%. I will now evaluate Evolution's key growth areas and risk factors. Each element will be scored on the likelihood of occurrence and its potential impact on the business. First, the legalization of online gambling. I rate this as high likelihood and high potential impact. As more jurisdictions regulate online gambling, the market is expected to expand rapidly, allowing Evolution to enhance its offerings and capture new customers. The ongoing legalization of iGaming is a significant opportunity for Evolution, not only in the US, but also in various other countries such as Canada, Brazil, and France. The US does most likely represent the biggest opportunity since it is the top online gambling market by gross gaming revenue at around $27 billion, according to H2 Gambling Capital. And according to @JAS Cloner on X, he forecast at least 32 states in total that will legalize online gambling in the United States. So this does present big upside here. The second growth area is to grow global casino market share in live casino, which I rate again as high likelihood and high impact. Evolution is strategically positioned to increase its share in the global live casino market. Their unique offerings, such as customizable live dealer experiences, allow operators to differentiate themselves in a competitive landscape. With strong demand for interactive gaming experiences, Evolution's focus on expanding its live casino portfolio can lead to substantial growth. There's then tech advancements, which I have as moderate likelihood and moderate potential impact. The online gambling industry is benefiting from several tailwinds, including advancements in camera and streaming technology that enhance the live gaming experience. Additionally, the increasing number of mobile players and opportunities for cross-selling products are expected to drive growth. Evolution's commitment to innovation, including AI-driven personalized gaming experiences and augmented reality applications, positions it favorably to leverage these trends. For risk factors, the first one is compliance with regulators, which I have as high likelihood and high impact. I was going to rate this as medium likelihood, but as shown with the recent UK compliance investigation and subsequent removal of Evolution's CFO, at least that's the rumor, compliance with gaming regulations is critical for Evolution's operations, especially as they expand into new markets. Non-compliance can lead to severe penalties, loss of licenses, and damage to the company's reputation, significantly affecting revenue and growth. Second, cyber attacks on products, high likelihood and high impact. The online gambling industry is a prime target for cyber attacks, which can compromise sensitive customer data and lead to a loss in revenue, resulting in potentially more regulatory scrutiny and a loss of customer trust, severely impacting the business. In Q3 24, the CEO was quoted as saying, "Simply put, someone else is selling our product." The third main risk I see is a change in end-user taste. I have this as medium likelihood and medium impact. The gaming industry is subject to rapidly changing consumer preferences, and if Evolution fails to adapt its offerings, it could lose market share and revenue. Like live casino disrupted land-based casinos, virtual reality can disrupt live casinos. The good news here is that Evolution acquired Net Entertainment, who does offer Gonzo Quest, which is a VR game that might give them a first-mover advantage in the space. Overall, Evolution demonstrates robust growth potential, driven by global online gambling legalization and its strong live casino market position. I like that future growth is not dependent on external M&A. However, the company faces significant risk, including regulatory compliance challenges, potential consumer preference shifts, and cybersecurity threats. Before we get to valuation, I want to briefly discuss two key metrics that I would track for Evolution. First, Game Rounds Index. The Game Rounds Index is a crucial KPI as it directly reflects the activity level in Evolution's network. This metric provides valuable insights into user engagement and the overall health of the company's core business. By tracking this quarterly update, investors can gauge the growth in player activity. Second, revenue per full-time employee. Revenue per full-time employee is an excellent measure of Evolution's operational efficiency, and it's particularly relevant since personnel costs are a substantial portion of their operating expenses and because they have been expanding their workforce significantly. The last section, valuation and technical analysis, will assess Evolution's intrinsic and relative value while also examining key technical indicators for ideal entry ranges. Evolution is currently in the growth stage of their business life cycle, which might lead one to think that a relative multiple like EV to sales would be the most relevant. However, they are highly profitable, so we'll start with the traditional DCF. Using investorsgrow.com and the ticker symbol EVO.ST, a 9% discount rate, a 2.5% perpetual growth rate, and 4 years of analyst free cash flow forecast, which is 34 analysts in total. Their fair value is 1,238 euros, which is 50% undervalued versus current price of 824 as of January 30th, 2025. This implies a 12% IRR. For reverse DCF, I use Stock Investor IQ, the ticker symbol EVO.ST, trailing 12-month Q3 24 free cash flow per share, a 9% discount rate, and a 15 price to free cash flow terminal multiple, which is the historic average for all stocks. In this case, Evolution would need free cash flow per share to grow only 2% per year for the next 10 years to justify its current price. This is well below all their historical averages. Their 3-year is at 50%, their 5 years at 68%, and their 10-year free cash flow per share CAGR is at 72%. Next, free cash flow yield. I use a combination of stockanalysis.com and investorsgrow.com. I use this ticker symbol EVVTY on Stock Analysis and EVO.ST on Investors Grow. I then came up with the trailing 12-month Q3 24 free cash flow yield of 8.06%, which is greater than the 3.24% 10-year average. If you look at 2025 free cash flow yield, that jumps up to 8.22% using analyst estimates of 1.25 billion. There was a 0.089 conversion there. So trailing 12-month and forward free cash flow yield both look appealing. Using EV to EBIT on Guru Focus and the ticker symbol EVVTY, their current EV to EBIT is 10.9 as of trailing 12-month Q3 24, which is less than the 31.6 10-year median and the 15.9 hotel leisure industry median, but slightly higher than their competitor Playtech at 8.8. Their 10-year median multiple implies a stock price of around $206 or 170% undervalued. Lastly, I look at EV to revenue, also from Guru Focus. Using EVVTY again, their EV to revenue as of trailing 12-month Q3 24 is 6.7, which is less than the 12.9 10-year median, but higher than the 2.3 hotel leisure industry median and Playtech, which is at 1.5. Their 10-year median multiple implies a stock price of $135 or 77% undervalued. Overall, the various valuation methods suggest that Evolution is undervalued, anywhere from around 30% to over 170% below fair value. The EV to EBIT method is the most optimistic, while the DCF method is the most conservative. Looking at them technically, they are on a long-term uptrend, plus 22% annualized over the last 5 years, plus 48% over the last 10 years, but have been on a downward trend since around May 21. The current price is both below the 1-year and 5-year 200-day exponential moving averages. In terms of short interest, the short percentage of float is 6%, according to Timoti on X, that's TIMONTTI, which on my rating scale is a medium level of short interest, as anything greater than 20% would be bearish. Looking at volume by different price points, the most significant buying support levels are between 870 and 1,103 on the 5-year chart. Overall, Evolution meets my quant criteria for a quality growth company, yet has open-ended questions on the qual piece. I don't understand why the stock is so cheap. Maybe investors are just short Europe. They have a great B2B business model and are positioned well to grow in live casino games and game shows within online gambling. The financials and valuation lead me to want to buy a starter position, but management, strategy, executive compensation structure, company culture, and significant risk factors does leave concern. So what have I decided to do? I decided that this was an asymmetrical risk-reward opportunity and bought EVVTY at 76.34. You can actually see my X post on January 22nd. It's a starter position, so less than 1% of my taxable account, that I'll potentially look to accumulate more of after fully digesting the Q4 report. And that wraps up today's episode of Stock Spotlight. I hope you found my analysis of Evolution AB both insightful and actionable. If you enjoyed today's episode, please subscribe, leave a rating, drop a comment, or take the episode poll. For real-time updates and insights, follow me on X at Invest091. Join me next on Wednesday, March 5th, when we'll shine the light on Duolingo, ticker symbol DUOL. Until then, keep your investments smart.